Money is supposed to represent stability, but what happens when an entire country runs out of it? When the government can't pay its bills, investors stop lending, and the whole economy begins to unravel. That's a sovereign debt crisis, and that's what we're going to be looking at in this video. Please do subscribe if you haven't already. It really helps this small channel grow. Every country borrows money. Through bonds, loans, or international institutions. It's how governments fund big projects, build infrastructure, or stabilize their economies during hard times. Borrowing isn't bad by itself. In fact, debt is part of how the modern world keeps spinning. But there's a fine line between healthy borrowing and dependency. And once that line is crossed, things can spiral quickly. A sovereign debt crisis happens when a country's debt grows so large or investors lose so much confidence that it can't refinance or repay what it owes. Imagine maxing out your credit cards and then realizing your credit score is tanked. You need new loans to pay the old ones, but no one will lend to you anymore. That's basically what happens to a government in crisis. Take Argentina, for example. It's defaulted 9 times in its history. The most recent big one was in 2020, when it couldn't repay around $65 billion in foreign bonds. Investors lost faith, inflation exploded, and the peso collapsed. The cycle repeated a familiar pattern, borrowing in good times, panic in bad ones, and eventually begging for help from institutions like the IMF. We can also look at Greece in 2010. Years of overspending, weak tax collection, and hidden budget deficits finally caught up with them. When the global financial crisis hit, investors suddenly realized Greek debt wasn't as safe as they thought it was. Bond yields shot up, meaning Greece had to pay higher and higher interest just to borrow. Soon the math stopped working. The government literally couldn't raise the money to pay back what it owed. The result, a massive bailout from the European Union and IMF, but with strings attached. Greece had to slash public spending, raise taxes, and privatise assets. The economy shrank by more than a quarter over the next few years. Unemployment soared, and ordinary people paid the price for decades of bad financial management. That's the brutal truth about a sovereign debt crisis. They don't just hurt investors, they devastate ordinary citizens. Wages collapse, prices rise, pensions vanish, hospitals and schools get cut, the currency tanks so imports like food and fuel suddenly cost double or triple. What starts as a financial problem quickly becomes a humanitarian one. So why do these crises keep happening? It usually comes down to a mix of politics, overconfidence, and global economics. When times are good, governments borrow more because investors are eager to lend. Everyone believes growth will continue forever. Then something changes. Maybe commodity prices crash, interest rates rise, or political instability sets in. Suddenly debt that looked manageable becomes unsustainable. A key factor is foreign-denominated debt, when countries borrow in dollars or euros instead of their own currency. This can make sense if local investors are limited, but it's incredibly risky. If your currency weakens, your debt burden effectively grows overnight. That's what happened to many emerging economies in the Asian financial crisis of 1997. Several Asian countries borrowed heavily in US dollars. When investor confidence wavered and currencies plunged, those debts ballooned. Nations had to beg the IMF for help, often under painful conditions. And those IMF bailouts are a key part of the story. The International Monetary Fund acts as a kind of global emergency lender. It steps in when no one else will. But its loans come with strict requirements. Austerity, reforms, budget cuts, all designed to restore investor confidence. Critics argue these measures often deepen the suffering of citizens, prioritizing bondholders over people. Supporters say they're necessary to stop economies from collapsing completely. Either way, the IMF often becomes the saviour and the villain in these crises. The other thing to understand is how interconnected global debt has become. When one country defaults, the shock can ripple across borders. Investors panic and start pulling money from other risky economies. That's what happened after Greece's crisis. Fear spread to Spain, Portugal, and Italy. The same thing happened in Latin America in the 1980s when Mexico defaulted. That's the psychological element. Confidence is everything in finance. Governments don't have to pay back all their debt at once, they just have to convince investors that they can at some point. The moment that belief fades, people stop lending and the system falls apart. Some economists argue that the world's entire financial system is more fragile now because of debt. Governments, corporations, and households have all borrowed more than ever before. Global debt hit over $330 trillion in 2025. That's over 3 times more than global GDP. When the cost of borrowing rises, someone somewhere is going to break. Sovereign debt crises might become less of an exception and more of a recurring feature of the global economy. So what happens after a country defaults? There are usually 3 options: restructuring, inflation, or bailout. Restructuring means negotiating with creditors to extend repayment periods or reduce what's owed. Inflation is the more sneaky route, printing money to pay off debt, which quietly transfers the pain to citizens as prices rise. Bailouts from the IMF, other countries, or international coalitions are the other option, but often the most politically unpopular in a country facing a crisis. In summary, a sovereign debt crisis is about balance between economic growth and discipline, between political promises and financial reality. When that balance breaks, the consequences are severe. People lose faith not just in money, but in institutions. Protests erupt and governments fall. It's the financial world's way of resetting itself, causing a huge amount of pain for everyday people. And that's why investors, economists, and policymakers watch debt levels like hawks. Because when a country owes more than it can repay, the question isn't if something will happen, it's a case of when. Debt can help build economies, but it can also destroy them. Borrow too much and the interest alone becomes a trap. Borrow in the wrong currency and your fate is out of your hands. Borrow without responsibility, and the country's people will be the ones who pay. Do you think there are any countries in today's economy that are close to a sovereign debt crisis, and what should they do to get themselves out of trouble? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching.